My Trading 212 individual stock portfolio is valued at £43,400. And I've held most of these positions for the last 5 years or so, and Amazon aside, they've all very much outperformed my expectations. But in October of 2023, I placed my last individual stock order, and today I'm going to explain exactly why I stopped and also the strategy that I'm using moving forwards in order to grow my wealth for retirement. But first, this video is for educational purposes only and is not financial advice. Nothing within this video is an investment recommendation. Always do your own research, and when you're investing, your capital is at risk.
If you find 3 wonderful businesses in your life, you'll get very rich.
As an investor, there are 3 investment portfolio variables: be above average, be average, or be below average. Warren Buffett, the bloke that we just heard from, very much sits in the above average category, with over $100 billion net worth from achieving a compounded annual growth rate of 19.9% over 60 years. Which was all from a strategy of individual stock picking. Now, let me be honest, I thought back in 2020 when I opened my Trading 212 Stocks and Shares ISA account that I could select individual stocks which I had high conviction on, that I thought were high quality companies that would also enable me to be perhaps not Warren Buffett level, but at least an above average investor, with the aim that I'd achieve better returns than something like an MSCI World Index, which is a benchmark index that covers 85% of the market capitalization of each country and has grown at a compounded annual growth rate of 10.32% over the last 46 years, or perhaps even perform better than a more popular index like the S&P 500, which has a compounded annual growth rate of 10.4% in the last 60 years, which I guess is a little bit more comparable from a time horizon perspective when we look at Warren Buffett's performance. Because here's the thing, the difference between a 10% market return and Buffett's 19.9% return on a £500 per month investment over the course of 30 years is the difference between having a portfolio of 1.46 million or £12.5 million. One admittedly makes you feel comfortable, but the other one means that you'll never have to check the price of anything ever again level of rich. And actually, when we take into account inflation on that 1.46 million, if we use the past 30 years worth of inflation data, well, that amount of money will only be worth about £700,000 in today's money. Which is still nothing to grumble at, I must add, but it's not going to make you rich, if you know what I mean. So why, after starting out buying individual stocks with the plan to become a slightly above average investor, did I kind of stop altogether and maybe accept that just becoming an average investor may be the best way forward? Well, it's kind of personal, but let's roll the clock back to 2017 and I'll explain exactly how I got started. About 8 years ago, I made my very first £400 investment, but it wasn't in individual stocks, it was in a collection of Vanguard funds, after I read this book called Tony Robbins' Money Master the Game. But as a newer investor, I got that sense of impatience, if you like, after about 2 years worth of investing, because I'd invested £11,700, but I'd only made an unrealised profit of £940. The equivalent to less than 500 quid a year and an amount that was nowhere near going to get me ahead financially. Now, don't get me wrong, 25-year-old me still saw the benefits in low-cost index fund investing, but I also saw a potential way forward to eke out my potential returns through individual stock picking. So I went on to open an account with Trading 212, who are also the sponsor of today's video. Trading 212 are a commission-free investing platform that allow you to start investing for as little as £1 across their choice of over 13,000 stocks and ETFs. And for me, when I opened my Trading 212 account, I was still able to invest in all of the Vanguard funds that I was previously investing into. I just did so on Trading 212 instead because it was cheaper to do so. But it also gave me the ability to buy those individual stocks as well. My investment thesis was to hold broad market tracking index funds to accept those kind of average rates of return that the market would provide. And then I could also spend some time doing lots of research on individual companies to achieve an above average rate of return on the rest of the portfolio. Perhaps a little bit easier said than done, but at least that was my thought process. Now, whatever your strategy is, you can build out your own investment portfolio through a stocks and shares ISA account, and then use the Trading 212's Pie feature to select a model or a social portfolio. Or alternatively, you can just make your own based on your own investment objectives and risk appetite. Now, to help you guys get started, Trading 212 have kindly offered all of my subscribers free fractional shares up to the value of £100 when you open an account with them by using the link down in the description below, or alternatively, you can scan the QR code, which I'll put up on screen somewhere here. And all you need to do is deposit £1 into your investment account. Alternatively, if you have opened an account with Trading212 in the last 10 days, you can enter the promo code Mitch and you'll still qualify for those free fractional shares up to the value of £100. Now, whilst I did progressively build my investment portfolio on Trading212, the stocks that you see today aren't the only stocks that I went on to purchase. There are a couple of losing ones in there too, which I went on to sell. One of those companies actually ended up filing for bankruptcy, and the other is down about 50% in the past 5 years. These losses, whilst not material to the overall value of my investment portfolio, certainly reminded me of the risks of individual stock investing. And sometimes I just imagine, what if I went all in or dumped a hell of a lot of money into some of these individual stocks, and then they hadn't have played out as I'd expected? The results could have been quite catastrophic. So in light of that, I've done a lot more research around individual stock picking, and the information that I've found out certainly has broadened my perspective a little bit. So now let's talk about that next. Remember when I said that being an individual stock picker was something that I strive towards to achieve slightly above average rates of returns? Well, the research that I'm about to present to you shows why the odds were completely stacked against me. Let me show you this paper called Do Stocks Outperform Treasury Bills? To which I, and probably most other investors out there, would kind of assume that they probably would. But this paper in fact ran simulations of randomly selected common stocks between 1926 and 2016, and the results would suggest quite the opposite. It says, when stated in terms of lifetime dollar wealth creation, the best performing 4% of listed companies explain the net gain for the entire US stock market since 1926, as other stocks collectively match treasury bills. That to me absolutely challenged how I thought about investing, because whilst when we are investing, we're thinking about it in the context of a long investing time horizon, knowing that 96% of companies just failed to outperform treasury bills over a 90-year period doesn't fill me with much confidence as an individual stock investor. To play devil's advocate here, I kind of thought, well, my investment time horizon isn't exactly 90 years. I might not even have 90 years on the planet. So what happens when we actually shorten that time horizon? Do those results and figures actually become more favorable to me? Well, let's take a look at JP Morgan's Agony and Ecstasy paper, which reports on the risks and rewards of concentrated stock positions. Now, it shows in this table over a 39-year time horizon, which is a little bit more reflective of where I'm at. It shows 42% of stocks experienced negative absolute returns between 1980 and 2019. And around 2/3 of the time, a concentrated position in a single stock would have underperformed a diversified position in the Russell 3000 index. Not quite the 96% worth of underperformance that we saw from the last study, but even so, it still doesn't make for great reading. While it also shows that the most successful companies that were able to generate massive wealth over the long run, only about 10% of all stocks since 1980 met the definition of mega winners, which is defined as a 500% or greater cumulative price return versus the Russell 3000 index. So in reality, we're looking at the top 10% of stocks that are going to be able to provide us with above average returns over, say, a 40-year investment time horizon. But with the world now changing quicker than it ever has done before, finding those top 10% is probably like finding a needle in a haystack. Because the reality is, high quality stocks of today may not be the same high quality stocks even 5 years from now, let alone 40 years from now. I think conventional investing wisdom was perhaps very much spoke about in a time where the world moved a lot slower, and the world just isn't like that anymore, and that for me is a risk that investors should consider. This 2019 paper from McKinsey kind of shows just how quickly the world is changing. In the 1970s and 80s, the average tenure of an S&P 500 listed company was about 35 years. By 2018, that dropped to about 20 years. And by 2030, it's estimated that the expected tenure will be just over 10 years. In just the span of 12 years, the expected tenure is expected to drop by half. So imagine what it's going to look like by 2040. Which is only 15 years away from now, and very much still within my overall investing time horizon. And look, you can see that very much playing out in practice when we compare the top 10 companies back in the 1990s by market capitalization versus that of the 2000s, versus 2010, and even versus today, whereby over a 35-year time horizon, there's not a single company in the top 10 today by market cap than there was in 1990. So what was once a period of time where one or a few companies could generate wealth across a whole generation of, say, 30 or 35 years or so. Whereas now investors may need to change the stocks that they're investing in more frequently than they ever have done before in order to achieve above average rates of returns. This presents another well-documented risk, as we can see from this paper called Trading is Hazardous to Your Wealth, the Common Stock Investment Performance of Individual Investors. Now, this paper was written 25 years ago in the year 2000, when S&P 500 constituents were a little bit more sticky, which I think makes the findings of this report ever more prevalent in 2025. So let me draw your attention to this chart. It's ranked investors into different buckets based on how frequently they change their portfolio holdings. You can see this portfolio turnover by looking at the grey bar. Now you can see quite clearly that as the grey bar increases, showing a higher monthly turnover of holdings, the lower that the net returns of a portfolio is, as you can see from the black bar. This inverse correlation between the two, to the point where just a couple of percentage changes in portfolio holdings can result in the overall underperformance against the S&P 500 index. And look, it's not just reports and studies like this that suggest more activity within the market contributes to lower than average market performance, because you only have to go onto Reddit to look at the track record of many retail investors when they're individual stock picking, like Hammock62, who bought Peloton for $140 a share. This stock now trades at $8 a share. Or Jason Syke, who bought Intel at the wrong time in 2021, with the stock being down 65% since then. On a side note, Intel have been the biggest wealth generator and the biggest wealth killer over the past 2 decades, depending on whether an investor timed the investments rightly or wrongly. But there are also hundreds of other stories about individuals who had high conviction on a stock investment but lost money. Here's the chart of many multi-billion-dollar companies who have experienced catastrophic losses of 70% or more, many of whom were perhaps thought of to be the next big thing in the respective industry that they operate in. Now, when I combine all of this research and information together, the investment thesis for a very concentrated individual stock portfolio very much becomes less appealing. So let me now share exactly what I do now. I have taken some profits off the table from my individual stock investments thanks to some wild outperformance. The reality is I do plan on holding the stocks that I've shown you in today's video within my investment portfolio, or at least for now. But I will be placing more of an emphasis on low-cost, broad market exchange traded funds for the foreseeable future. It just eliminates some of that guesswork away from investing. It eliminates some of that idiosyncratic risk, which is just a fancy way of saying the risk associated with one specific investment. And in actual fact, the more money that's in my investment portfolio, the more it's actually going to fluctuate from a nominal pound and pence amount. And because of that, I'm certainly more inclined now to try and reduce some of the portfolio's beta, which my Trading 212 AI analyst tells me that is currently 1.15 for my portfolio. So it's about 15% more volatile than the broader stock market as it stands right now. So I just want to try and reduce some of that volatility exposure, if you like, especially as the portfolio grows in value. It doesn't mean that I'll never buy individual stocks ever again. It just means for now, I'm very much focusing on low cost, broad market index funds, accepting the average market returns could still provide above average results if I invest for long enough and I invest enough money into the market and achieve returns whilst outperforming inflation. So that's my plan, but if you want to know what it looks like building an investment portfolio from scratch with just £10 a day, then be sure to check out this video next. With that being said, I'll see you over in the next one.